us. We want to talk about 2025 and how you're feeling on this day.
Look, this has been a great week. This is what the market needed here short term, was a breather on the 10-year. That's the big story. And I think that's the thing most investors should keep their eye on, because there's a direct correlation with what's going to happen in the 10-year and what happens in the equity markets. We come into this year very bullish, overweight technology, but we've told our clients we think we're going to have the tale of two stories in 2025. We feel like the first part of the year will be really strong, but we see some dark clouds that we expect a double-digit correction in the S&P at some point in time, starting to materialize probably in the second quarter. I hope I'm wrong, because we'll continue to stay fully invested. However, we think that rates are going to go back over 5% on the 10-year because the dollar is going to stay strong. Inflation is going to continue to accelerate, and that's going to take liquidity out of the system, unfortunately.
So how are you going to put a portfolio together for this year? Are you going to be hedging? You're going to have some growth and more aggressive plays and then some more protective plays?
So right now, we're pretty much risk on, extremely overweight growth. We don't own any defensive names. We got out of healthcare and utilities and consumer staples in our tactical strategies. We do have some money market in the position right now just to be able to buy some dips. But if we start to see what we think is going to happen in regards to inflation reaccelerating, we will start rotating into defensive areas like gold, maybe healthcare, maybe utilities, although they're very interest rate sensitive. But cash may be king in that type of scenario, because we don't think it's going to be this drawn out recession type of crash. We think it's just going to be a reset that you'll probably want to buy right back in the next 3 to 6 months, because this AI boom is going to be real, and I think people will get back in. But you have to be ready for what's probably going to come at some point in time in 2025.
And look, that's what they did all last year, right? I mean, I think we made it over 20 new highs in the S&P 500. Each time there were dips, I remember that early August, there was a big dip. If you bought the dips, you did okay, right?
That's exactly right. And I think that'll be the same story this year. Although I think this dip, if we're right on inflation, this dip will last longer. We won't get that quick snapback. It could go from second quarter towards the end of the fourth quarter of this year. But we'll just have to wait and see how we play it. And the other thing, too, is the new administration coming in is saying they're going to reduce the deficit spending, which a lot of people, myself, are in favor of. That's going to be taking money out of the system. The government spending has been a big contributor to GDP growth. And if you take $1 trillion or $2 trillion out, there will be some negative impacts on that. So sometimes you have to take one step back to take several steps forward, and we're prepared for that.
Understood. So at this point now, on the correction time, you talk about 15, 20%. That is more of a reset, and it's a buying opportunity. And you said right now you're risk on in growth. When there's a pullback, right, you see a big sell-off day, what do you buy?
So we're going to buy, our favorite name is NVIDIA. And I think if we do see a 15 to 20% correction in the S&P, and for full disclosure, we own NVIDIA right now. It's one of our biggest holdings. I would expect a name like that to lose at least 30 to 40% of its value. So we would look at names like NVIDIA, look at Palantir, again, focusing on mega cap tech, because I think technology is going to continue to lead. And then there'll be other areas that come up that we don't even have on our radar right now. But those are the types of names that are going to have leadership in the AI space, because the AI boom is real, and I think it's going to lead us to a very prosperous decade. We're just got to navigate this so-called air pocket that we're worried about.
Right. Look, the U.S. dollar, I was reading about the U.S. versus international investing and the strong U.S. dollar that is expected to stay so versus the other currencies. How do you invest in the U.S. versus international and emerging markets and things like that? Like the U.S. better?
We do. We actually have in our tactical strategy zero international exposure. You know, and a year and a half ago, we were very bullish on India, and we rode that, but we got completely out of India. And when you look around the globe right now, it is crystal clear that the U.S. is the best place to be. Most of the world is in a deflationary environment. You look at China, they're pretty much in a recession. You're seeing their rates plummet. So the rest of the world right now is having trouble. Right now, the U.S. is the best place to be, and I think that's going to continue. So we're going to stay domestically focused for the next 12 months until something changes fundamentally.
Right, understood. When you think about some of the other, you mentioned gold, and I think about commodities. I mean, oil's been close to $80 this week and has crossed the $80 mark. Commodities, do you have certain commodities that you like more than others?
So I think right now, if you look at oil, this is another reason why, the energy play right now looks pretty good, but that's going to ultimately cause inflation to get worse as these commodity prices are continuing to go up. And so a broad-based commodity ETF basket would be something that I think investors could use from a diversification perspective. We don't currently have it because of the volatility and because we believe that if we do get what we expect to materialize in the second quarter, it'll be broad-based and commodities, again, have a higher volatility. So I would expect those to get hit. But energy stocks and the cash flow there could potentially be a great place to be once we have this correction. But lastly, I'll say that if the Trump administration does increase production, that should bring oil prices down. And if that does, then you'll want to look in other areas. But for right now, it's continuing to accelerate.
Right, understood. And the 10-year bond, as we watch, Larry Fink was talking about the wider range of the 10-year bond yield. He even said 5.5%, 4.5%. You're watching this really closely. Some of your thoughts there, and combined with government spending, what do you think about where yields are headed?
I think the 10-year, I think 5% is a given, frankly. I think it's just a matter of when it happens, not if. And I expect it to happen sometime in the first half. And so we would not be surprised if it gets to that 5.5% range, especially if the Fed cuts rates. Look, from the time they've cut rates, the 10-year has done nothing but go up. We've had this little reprieve over the last few days, but the trend has been up. And that's because when you cut rates, when you're not in a recession, that is inflationary in itself. And you have growth accelerating, you have cash coming off the sidelines and putting stimulus, the 10-year is going to keep going up.
Yeah, and you noted, in addition to Meta, you said NVIDIA, you were talking about that Meta, NVIDIA, triple Qs. Those are some things that you've been long. At the same time, higher inflation, to your point, you talked about the higher rate environment. You said that could present some great opportunities in fixed income. What would you do there?
So one of the things that I think could materialize there is you could get corporate debt at 8, 9, 10%, and that type of environment, if the 10-year goes to 5 to 5.5%. Right now, we have some high-yielding ETFs for our clients on the fixed income side that are yielding between 7 and 8% in this environment. So if the environment gets better for rates, which will be worse for the equity markets, in our opinion, that should only make fixed income even more attractive. So you could have investors actually take less risk and still get the overall total return that they would traditionally expect in an equity style portfolio.
All right, Eddie Ghabour, great to see you always in this new year. Eddie
Thank
Ghabour,
you for having
owner,
me.
Key Advisors Wealth Management. May it be a nice, healthy, prosperous one for you.